Hey everyone, today we're diving into a big question on many investors' minds. Are we heading into another lost decade? Let's take a closer look at history, valuations, and some smart investing strategies to see what we can learn. There's an old saying in the world of investing: history doesn't repeat itself, but it often rhymes. As markets hit new highs and valuations soar, it's natural to wonder if we're approaching a new era of stagnant returns, similar to the lost decades of the past. Now, no one can predict the future, but history offers some valuable insights. Let's take a look at nearly a century of the S&P 500's performance. We see three major periods: 1929, 1968, and 2000, when excessive market valuations led to long, drawn-out recoveries. First, the 1929 crash. Sparked by extreme market speculation, it took nearly 27 years for the S&P to reach its previous high. Next, the 1968 peak. High valuations followed by stagflation and economic challenges meant it took around 24 years to break through the same level. And finally, the dot-com bubble in 2000. Market euphoria drove valuations far beyond fundamentals, resulting in a 15-year journey to reclaim prior highs. Despite different causes, the pattern is clear. When markets become excessively overvalued, future returns suffer. So what about today? Key valuation metrics suggest we might be in a similar situation. The CAPE ratio and the Buffett indicator are both flashing warnings, showing markets are currently 100% plus overvalued. Historical data shows that whenever markets have reached such overvaluation levels, average returns over the next decade have hovered around 0% or worse. As legendary investors like Warren Buffett and Charlie Munger have noted, investing at inflated prices locks in lower future returns. It's not speculation, it's math. Now you might be thinking, should I try to time the market? History teaches us that market timing is nearly impossible to get right. Instead, focus on what you can control. Stay invested through different market cycles. Use dollar-cost averaging to smooth out purchase prices over time. Practice valuation-aware investing, especially when selecting individual stocks. Dollar-cost averaging is a powerful tool. By consistently investing a fixed amount regardless of market conditions, you naturally buy more when prices are low and less when prices are high. Over time, this reduces the risk of investing a lump sum right before a downturn. The bottom line? History shows that periods of excessive valuation are often followed by years, even decades, of low or negative real returns. But that doesn't mean you should panic. The key isn't panic, it's preparation. Understand your goals, know the risks, and make strategic choices like dollar-cost averaging and investing in quality at reasonable prices. As Charlie Munger once said, the big money is not in the buying and selling, but in the waiting. Remember, this video is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial professional before making any investment decisions. Thanks for watching and stay smart with your investing.